4 trades over 25K that I'm doing right now. Number 1, HSBC. It's a European bank. I think it's really undervalued. It's flush with cash. It's heavily invested in China. Take that as a good or a bad thing. It's super stable and very established. It's had a recent change of leadership. It's a money printing machine. It's a foreign company though, so make sure that you hold it in an individual account for tax benefits. You get a tax rebate from the government for foreign tax paid on dividends. Check your tax laws and make sure it's right for you. How to play it? Buy the stock and sell a call around it. Sell calls against your position a few months out while you collect that fat dividend. Number 2, Realty Income. Everybody should know this company. It's a monthly paying company. It's increased dividends every year for over 26 years now. It's got solid leadership, still the same leadership, I believe. It's a rules-based investing, so they don't just do deals on a hunch. It's hyper diversified. It's really large. Its focus is on standalone buildings. It's best bought in Roth IRAs for tax-free auto-reinvesting compounding. Check your tax laws. How to play it? I sell puts a little bit underneath the strike price a month or 2 out, and I try to build ownership, stack that ownership. 3, Equinor, ticker symbol EQNR. Equinor is a Norwegian oil producer, a self-apologetic one. Prints money like there's no tomorrow. 170 million Europeans depend on its products. Super fat, sustainable dividend comes out of this stock 4 times a year. Best bought in individual taxable account. It's a foreign company, just like HSBC. So, you want to get that tax credit on the foreign dividend tax. Check your tax laws. How to play it? Buy stock and sell calls on it just like HSBC and collect the fat dividend in the meantime. Number 4, Robinhood, ticker symbol HOOD, HOOD. Now this is the basis for my ninja strategy. If you don't know what the ninja strategy is, I suggest take a look at a couple videos that I made about it. It's basically filling up an account with assets and then taking out margin to use as collateral in order to sell puts against the company. The reason why that worked pretty well with Robinhood is because it had a negative enterprise value. This means that the cash on the balance sheet of the company was worth more than the market cap. That's a signal for extreme undervaluation. That's no longer the case, so the ninja strategy doesn't necessarily apply. You can still do it, but it's a little bit riskier. Why is Robinhood still a good idea for investment? It's aggressively growing. It's a retail broker and it keeps accumulating AUC, assets under custody. The more AUC you have, the more products you can offer to your customers with large sums. It also keeps growing gold membership, which is a $5 per month fee. So it's got a subscription model, kind of like Spotify or Netflix, you name it. That $5 gold membership gives a lot of value to the customers. It gives better rates on margin. You get better rates on uninvested cash. You get $1,000 margin-free investing. You get some level 2 data. You get some Morningstar research analysis. There are many perks to being a gold member. Currently, I'm a gold member of Robinhood, and I love it. I think it's very valuable. Robinhood is also flush with cash. I like companies that are flush with cash. Not all of them are. Realty Income is a typical real estate investment trust, or REIT, which operates obviously with debt, they issue shares, and they fund their expansion that way. It's not necessarily a bad thing for a company to have debt, especially if they're using it productively. For example, I take on margin and I try to make more money off of that margin than I'm borrowing. So therefore, in this case, the debt on my personal balance sheet is not necessarily a bad thing. I think Robinhood is still undervalued. The value proposition for investors and traders is clear. It's the only platform that I know that still offers 24-hour trading Monday through Friday. It's best bought in any account, really. You can buy it in an individual account, you can buy it in a Roth or just a regular IRA. Since they don't dish out dividends and the company is going to grow over time, the stock price might go up without having to sell. Therefore, you get unrealized capital gains. If you hold the company for years, especially over a year, you will get long-term capital gains tax if you sell. And a little known trick for investors is that the first 44, or they may have changed that number by now, but the first 44,000 of realized capital gains that are long-term capital gains will not be taxed. Check your tax laws. Again, how to play it? Well, use the ninja strat. Or if you're not confident enough in the company staying above that $15 level or so, then you can just stack ownership. You can sell puts, you can get into the company any way you like. But this is probably one of those companies that's going to compound and grow over the years to come. So personally, I think he would be best in an individual account if you're younger than, let's say, 45 or 40 years old. Good luck with these. Hopefully you got some value out of this. Let me know how many of these companies you actually own in the comments below.